Guys, thank you very much. You've done a great job. And, we had a little bit of confusion because Scott Leonard had not replied to answer mine, but Scott's on to speak about a SPAC. And SPACs are incredibly hot right now. I think there's a hedge fund manager in New York, David Ackman, who just raised $4.5 billion for a SPAC. And for people who don't own a SPAC, is a special purpose acquisition vehicle. And actually, I'm gonna let Scott take it away. So Scott, why don't you introduce yourself, pull up your slideshow, and talk to us about what you're doing. You've got 15 minutes.
Great. I didn't want to interrupt, so I've been on waiting, but
No worries, Scott. Let's go. We're tight. Thanks.
So I'm Scott Leonard. I'm the CEO of Sustainable Opportunities Acquisition Corporation. We're a $300 million SPAC. We are dedicated to making ESG-oriented investments. As a quick primer, if you think about SPACs, we're a hybrid form of private equity. So to the extent that you think about us in terms of private equity, we are making investments that are directed to a company that's privately owned. We're getting some feedback, so I don't know if everybody's clear.
It's like the biggest SPAC in Texas, so.
Great. So do we have a slideshow?
We do. So, but let me round out before we get into the slides, because people get too much time to look at slides. But I'll say that, when you think about SPACs, we're looking for very good private companies that need additional capital to either enable growth, to get a different ownership, some liquidity, or to delever the balance sheet. And we've seen that happen in great numbers in the past year. We think acquisition corporations or SPACs have really taken off in the terms of the amount of dollar volume. We've seen $19 billion raised in SPAC capital this year on the public market exchanges, compared to 13 for all of 2019, which is a banner year as well. We're seeing.
Scott, is that global? 19 billion?
That's a U.S. number only. So this
because I have a hedge fund guy who raised $1 billion in 2 SPACs for cannabis last year.
Yep.
In Canada. That's in Canada. So keep on going. Sorry.
Yeah, no, there's and all SPACs are, I shouldn't say all, most SPACs are thematic. Some go after consumer products, some go after energy investments, some go after cannabis, as you said. We chose a thematic that was specifically oriented towards ESG or sustainable investing. So we've got a fund that can look at pretty much any type of investment, but it has to fit an ESG or an environmental, social, and governance screening criteria. We're the first ESG SPACs. We think there'll be others that copy us. As I said, we've raised up $300 million. Our plan is to put that to work in one fell swoop. We plan to bring, anywhere between 100 to $400 or $500 million of additional co-invest money in the form of a PIPE alongside with us. So we expect to write a check that'll be north of $500 million for one company. And at the end of the transaction, what we call de-SPAC, we'll end up with a company that's got the right capital structure. That's from our case, that's somebody that's partnered with a group of seasoned operators and investors. And that company will also have a public listing. So there's a lot of times when people think of SPACs as a reverse way to enter the public markets. As I said, we think of it as a hybrid. I'm going to share my screen right now to just walk through kind of our overall thesis.
And Scott, before we go any further, where are you physically located?
Yeah, we've got offices in Dallas, Houston, New York, and Minneapolis.
And you are in Dallas right now?
I'm in Dallas.
Perfect. Okay, great. That's all I wanted to know. Okay, slideshow?
Yep. Let's see.
Just do a share screen?
Oops.
Awesome, great.
There you go. So, as I said before, let me go up. We are Sustainable Opportunities Acquisition Corp, and this is the deck that we use to talk to folks. We're getting an understanding about what we intend to do. So, our starting point is that we tend to see greater value in investments that we make than others do, in large part because we are a set of transformative operators. We've got over 100 plus years of operating. We've got over 50 plus years of investing when you look across our team. We firmly believe that when you look at the type of transformations that we've led in the past, when you look at the type of transformations that we've looked to enable with our capital, we'll not only have the ability to unlock significant earnings power inside of the company that we partner with, but we'll also have the chance to make that company eligible to other ESG investors. And we think by increasing the ESG focus of the company, that'll increase the amount of potential investors that might put a higher premium on it than if it was just being valued as a cash flow oriented company. And you might ask, well, why is that? And the rough answer is that ESG capital is growing at a tremendous pace, over 20% per annum in terms of capital that investors are dedicating towards an ESG thematic. Just to give it by the numbers, in 2018, we had over $30 trillion dedicated to ESG capital. We think that number will double by 2022. And we think that by 2025, there'll be over $120 trillion of ESG capital looking to make both debt and equity investments. We've seen, as you can see in the top right, the amount of press that folks like BlackRock's Fink and State Street's Terpeleva have given in very large ways to the importance of ESG for their own funds is it's color commentary on top of the numbers. But we know that there's going to be a lot of ESG capital, and we know that ESG oriented companies outperform those that are laggards by as much as 40%. Companies that have an ESG focus tend to be higher quality stocks. That's an academic definition that we use. They tend to see much less frequent chances of large price declines, and they tend to see much lower odds of becoming insolvent, and they produce higher returns when you put it on a 1, 2, 3, 5-year basis. So we know that ESG is not only drawing in a tremendous amount of capital, but that the spread between folks that have an ESG story and a strategy that involves ESG and those that don't is a gap as well. And I show up page 5 of this presentation. We think that when it comes to measuring environmental, social, and governance standards, when viewed through the lens of an investor, progress matters more than perfection. Quite simply, it used to be the case that when you thought of an ESG or sustainable investment, you would think of only pure green companies that were disruptors requiring large amounts of capital with business models that may or may not succeed. But we pulled out a number of examples. We highlighted 4 household names: Johnson Controls, BASF, Caterpillar, Honda. These are all companies that qualify for the MSCI ESG index, which is kind of one of the gold standards in terms of evaluating who makes it and who's deemed an ESG oriented company. We know that both disruptors that are truly green companies as well as typical businesses that have adopted an ESG strategy can make their way into that index and access that $120 trillion of capital. And we also know that the progress that companies that are more traditional make pays. Page 6 outlines over $4 billion of recurring profits that have been generated by big household names: Walmart, United Airlines, Unilever. These are all companies that are reported publicly where they got bang for the buck for the ESG programs that they put inside of their company. So we know that not only is there a large amount of ESG capital, we know that ESG outperforms, we know that traditional companies can be deemed to be ESG friendly, and we know that when you run the programs right, they add to the bottom line. And the last thing I would say is that we think every company in America is going to have to undertake a transformation to be more sustainable and ESG oriented. And we believe that for the companies that step forward and do something different today, particularly to impact climate change, to embrace the social changes that are going on, to embrace good governance, diversity, inclusion, as well as transparency, that this is a great time to look at a company and have an inflection point.